Good evening, everybody. Once again, welcome to our final session of Knowledge Hub. And first of all, I wanted to say thank you to Taras Kulish and Simatyuk, who put a lot of work in making this event happen. That work that nobody can see. And I also want to say thank you to all of our attendees, those who attended all of the sessions, those who attended some of the sessions, and those who attended none of the sessions, but they look forward to having our recordings. Also, thank you to sponsors and speakers who took their time out of their busy schedule to present valuable information to us. We hope that these sessions delivered valuable knowledge and information to all of you, and I hope personally that you will be able to utilize this information within your organizations, or potentially it will be a motive for you to make that donation that you've been thinking about for a while. So as Steve mentioned, I'm from Ukraine originally. I'm a first-generation immigrant in my family. I came to Canada in 2013. I have parents in Ukraine and a city called Poltava, and I also have a younger brother in Alberta who we brought there a few years ago. And yes, I am a consultant with IG Wealth Management, and I've been with them since December 2014. In my practice, currently I have 168 households that my team and I serve at this point, and we are actively expanding. I cannot say that we are across Canada, but we are licensed in Ontario and Alberta, and our goal is to cover Canada 100% within the next 5 years. And yes, ideally, I want to extend internationally, including Ukraine as well. So so today it's about finding ways to make the most out of someone's situation and finding ways to do things in a better way that is going to leave the donor and charity that they care about much better off, including their beneficiaries, children, and the people that they love. We will discuss charitable giving as a strategic part of your comprehensive financial plan. And usually we do this presentation for about an hour and a half to 2 hours, but I'll try to squeeze it in for you in 20 minutes. So tonight we will show you why you should consider us as a trusted partner when it comes to charitable giving. When we work with charities and churches and non-for-profits, we help them by managing their assets and by working with their donors and educating and helping them with charitable giving. And a little bit of disclosure here, keep in mind that none of the presented information should be considered as a suggested strategy or advice. Like, each and every situation is so unique, and we strongly encourage you to contact us first to set up review meeting before implementing any strategy moving forward. So we are a successful company, and we've been around since 1926. We serve over 1 million families across the country, and we do provide comprehensive financial planning. And our parent company, Power Financial Corp, it's one of the world's largest and most well-respected financial firms. We own companies like McKinsey Investments, IPC, Wealthsimple, and on insurance side, it's Canada Life, Great-West Life, and some other firms as well. We have some partnerships on investment side, insurance side, banking side, ideas that we're trying to combine our internal expertise with this external partnership to deliver greater value to our clients. And we also believe in a strategy of leading as a company, being a strong corporate citizen and giving back. We support more than 1,700 charities and non-for-profits across country. So when it comes to financial planning, our ultimate goal is to help you achieve financial well-being. And to do so, we look at the 6 major areas of your financial affairs. And you can see some of them on the screen. Like, sharing your wealth is one of them. And again, depending on the complexity of your situation, some of the areas might impact others. And this is the reason why we need to have a synchronized approach in order to maximize your plan. So when it comes to sharing your wealth, and you can see it as a last sort of a column on this slide, it comes to intergenerational wealth planning and transfer, philanthropic planning, charitable giving planning, donor advice funds, and many other areas. So here, today we are going to discuss charitable giving specifically and explore key tax scenarios to help you to make the most of your giving and leaving a legacy. So imagine you worked hard to get where you are today, and you may be thinking about the best approach to share your wealth. So you give because you are a giving person, although giving to charity should be planned like all of your other finances to get the most out of your giving. And a carefully constructed giving plan helps you create a legacy of giving that expresses your values and the causes that you care about. And don't wait to donate until your death. Like instead, you can start giving during your lifetime to maximize tax benefits already, and so your giving already begins to have an impact for others. And also making charitable decisions and discussions now will kickstart the discussions for families about how money will be transferred between generations, and children can sit on the boards of private foundations and they can be involved in discussions about what causes it should support. And I really like the quote from Winston Churchill: we make a living by what we get, and we make a life by what we give. Just feel it for a second. So this slide was used by Paul Nazareth from CAGP during our last session. I really liked it. I got his blessing to use it tonight. So why people donate? As you can see, most of the times people do not donate because of the tax credits or tax deductions. They donate because they care. Compassion, beliefs, contributions to the community, religion, and many other reasons. Often, what we see with charitable giving, because it is so altruistic in nature, people want to give because they care. People who don't care don't give, as simple as that. And so that's how you define your potential donors. That's where your focus should be as a charitable non-for-profit organization. Like you have to determine your why and relate it to the donor's why. And sometimes you also might need to grow that why within your donor. So when it comes to how, like you have plenty of professionals who can help you with it. And we had them presenting already during our previous sessions, like a collection and use of data by Alexander Romanko. Bill Patra can help you with how to do successful fundraising. Victor Lishina can help you with how to arrange charitable gifts through the will. Taras Kulish can help you with how to establish a registry organization and all other legal matters. Like my team and I at IG Wealth Management, we can help you with how to donate to charitable organization or how to get more donations from your donors. So how to manage your organization's assets and other areas related to charitable giving and financial planning. But keep in mind that when it comes to why it's on you. So like I don't want to bore you with some technical information on tax credits and etc. But as we'll discuss further in details, there are several advantages to planning carefully in order to maximize the benefits of your charitable giving, especially when it comes to tax efficiency. Thinking long-term about the implications for your overall estate's tax liability and your family's well-being is important. It is also important to evaluate when to donate, what to donate, and how to donate. So before we get into various methods and plan giving, we should provide some background on tax implications. So the federal government has supported the objectives of increasing bequests and other estate gifts by implementing legislation designed to encourage more and large gifts to charities from individuals. As Paul Nazareth mentioned last week, Canada is the most generous country when it comes to charitable tax credits and tax deductions, and it is so true. Like the maximum amount of charitable donation that you can claim is 75% of your net income plus 25% of any capital gain incurred upon the gift of capital property. And again, like it depends on the province, because keep in mind, for instance, in Quebec, the limit is 100% of your net income for provincial tax purposes. Again, where a sizable gift has been made causing these limits to be exceeded, there is a 5-year carry forward provision, which should allow for the entire donation to be claimed over 5 years. If the gift is made at death and received by the charity within the first 60 months after the date of a death, the limit is increased to 100%. So keep that in mind. And another, like when a corporation makes a charitable gift, the corporation receives a tax deduction, which reduces its income and will therefore reduce the taxes it has to pay. So just keep in mind, it's when individual is donating, it's tax credits. When corporations donating, it's tax deductions. So one of my goals tonight is to make sure that each one of you understand that there are more than just three. My apologies. There are more than just 3-4 ways to donate, and as you can see on this slide, there are some traditional ones. For instance, cash donations, in-kind donations, upon death through the will donations, or you can simply support your favorite charity during some of the events and help them with fundraiser, for instance, golf tournaments. And some of the ways that are not as common, but they might be more preferred from cost to benefit point of view. So we start with the gifts registered investment plans. We call it RSP wash. There's also donor advice fund program. Anil Gokhale from Toronto Foundation was talking a bit about it during our previous presentation. Then corporate donations, as we mentioned, donations are transferred between charitable organizations. Now, life insurance purchased by a donor, that might be an option. Another option is life insurance purchased by charitable organizations on donor's name. So this one can also be utilized for transfers between philanthropic organizations. And for your reference, life insurance is deemed to be worth nil for the purposes of calculating the disbursement quota per income tax regulations. And therefore, the purchase of life insurance should not cause issues with the disbursement quota, but given that it's carved out from these calculations. But however, we also have to keep in mind Section 149 of Income Tax Act that contains an anti-avoidance rule. So when we work with charitable organizations, we work directly with their legal and financial counselors. So other ways is charitable life annuity and charitable insured annuity, and also charitable remainder trust or gift of private corporations shares to public charity or to private foundations. So that's another way. And also there are some other ones, but these ones are most interesting ones. And keep in mind that each and every strategy has its nuances, and there is never the same case. And also, if we have, I'm sure we have some directors of different charitable organizations. Most successful organizations, they have a separate department, the charitable giving department, that work, develop, and maintain relationship with their donors. Successful organizations would never depend on one source of funding. For example, government, like since funding can be reduced or simply disappear at some point, and then that organization might experience some challenges moving forward. So due to the time limits, I will not be going into details of each one of the strategies, but rather will cover a few. And again, just a reminder that don't take it as an advice to action. We're encouraging you to contact us to review your personal situation and determine strategy then. So the first one, charitable bequests. The simplest option for all is to leave the charity a bequest in your will. It could be a sum of money or gift in kind, such as artwork, securities, or real estate. You can give the charity the freedom to use it as they see fit. Remember that charity has the right to decline a gift if they wish to do so. In some cases, you can direct the gift towards a specific activity, but check with the charity beforehand to ensure that this is acceptable. We've talked about it during one of our previous sessions. There were a lot of cases when it wasn't really, there was no fit for that. And your estate will receive a charitable donation tax receipt. Depending on the size of and the nature of your gift, the tax credits could eliminate all of the income tax or on your final tax return, and possibly on the return for the immediately preceding year as well. So that might be one of the options. Another option is donate publicly traded stocks or securities. Again, one of the common ways to donate. Selling securities in order to raise the cash to make charitable gift can trigger capital gain, resulting in 50% of the gain being included in your income. However, the Income Tax Act provides that donation of publicly listed security directly to registered charity is more tax advantageous, since you do not have to report any portion of the resulting capital gains on direct in-kind donation as taxable capital gain, which is helpful. Now, there was one of the questions, life insurance policy. So I have a link for the video, and I'll send it later after I'm done presenting so you can review it. But when you donate life insurance policy to your favorite charity, you ensure that the charity receives the total insurance proceeds upon your death. Like life insurance policy donated to during your lifetime would fall under one of the three categories. The first one, you can apply to life insurance company for a new policy, and once it is issued and after payment of the first monthly premium, you would transfer ownership of the policy to a charity. So second category is you can donate an existing policy having a cash value and continuing premiums. So again, we are talking about permanent life insurance that builds up the cash value. And then the third category is you can donate a paid up policy that you no longer require. And again, you'll receive a charitable receipt for the net cash surrender value or for the fair market value of it. And again, if there are some nuances that you have to keep in mind, you might need to hire actuarial who will do evaluation for that.
Alexander, 5 minutes. 5 minutes, please.
Thank you so much, Stefan. So with these options, it gives you potential to donate much more than the dollars you actually put in. And that's why people purchase permanent life insurance, to cover tax and debt liabilities to beneficiaries, and potentially do estate equalization and many other strategies that are there. Now, there are some issues with given policies. If it is an existing policy with the cash surrender value above adjusted cost base, there is the taxable disposition when donating, and most often it will be offset by tax receipt anyhow. And at a future date, the client might not want to fund the premium anymore, so the charity might be stuck with the premium bill each year. So that has to be kept in mind. And then we have a few lawyers here. There was a case in DC last year where the provincial insurance regulators stepped in as they felt that it was trafficking in an insurance policy when an elderly person gave the policy to a charity. And this has held up a lot of transfers of existing policies to a charity. So I'll send the link about it so you can read a little bit more. Now, another option is if you own a life insurance policy, RSP, RIF, or TFSAs, you can designate a charity as the beneficiary. So keep that in mind. You can also establish private foundation, and private foundation does more than ensure your generosity will live on. There are some nuances and there are some costs that involved in that. Like Taras Kulish can also attest to that. So other option is annuity. So what is an annuity? Annuity is a contract between you and insurance company in which you make a lump sum payment or series of payments, and in return you receive regular disbursements beginning either immediately or at some point in the future. Again, this is a very powerful tool if you would apply it for the charitable donations, because there are some tax savings. For instance, annuity income likely will be tax-free if the annuity is appropriately structured, and those will not create or increase any old age securities clawback. So other option is charitable remainder trust. It's again a very simple arrangement whereby an individual makes an irrevocable donation to registered charity, the charity agrees to place the donated amount in inter vivos or living trust, and the income from that trust is paid to the donor for life. And upon the donor's death, the charity has access to the assets of the trust. And the final option that I'd like to present you, it's like be careful. There are some organizations who actually ask you to leverage or to take a loan so they can get some charitable donations. So keep in mind there is also with that you're taking on some risk on that. Yeah, so as we discussed, there are some options to donate through the corporations, and again, it really comes to full financial review and understanding what is better in your case. So very last thing for tonight is something that Anil Gokhale talked about, and it's a donor advised fund. So think of it as creating your own private foundation, but without the administrative responsibilities or the high upfront costs. You can name your account and personally recommended grants to desired charitable organizations on an annual basis. Ultimately, the program helps you maximize your giving while minimizing the complexity. That's the entire idea behind it. And your main benefits is simplicity. Like you can enjoy the benefits of a private foundation without all the upfront costs, time commitments, and administrative hustle. There is a flexibility, like you can contribute cash, public listed securities, or other assets, or consider naming the fund as the beneficiary of a life insurance policy, RSP, RIF, TFSAs. And there are some many other features that you can have. Now, you might be thinking it's for very, very wealthy families. In reality, it's not. A minimum donation has to be at least $10,000 to establish an account, and that will be your own private foundation that you can manage moving forward. There is a succession as well, like you can appoint your kids or grandkids who can control and proceed with your causes. So that's about it. This is my team, and I wanted to say thank you.